ரிசர்வ் வங்கி ஆளுநர் திரு சக்தி காந்ததாஸ் தற்போது செய்தியாளர்களை சந்தித்து வருகிறார். அது நேரலையை தற்போது காணலாம்.
In July, although the downturn eased relative to the June reading. Headline inflation, which was 5.8% in March, was placed at 6.1% in the provisional estimates for June 2020. Inflation pressures were evident across all subgroups. Households 1 year ahead inflation expectations were lower than their 3 months ahead expectations in July 2020 round of the Reserve Bank's survey, indicating their anticipation of lower inflation over the longer horizon. Producers' sentiment on input prices remained muted as their salary outgoes fell. The selling price contracted in Q1 in April to June round of the Reserve Bank's Industrial Outlook survey. India's merchandise exports contracted for the fourth successive month in June 2020, although the pace of fall moderated. Imports fell sharply in June in a broad-based manner, reflecting weak domestic demand and low international crude oil prices. The merchandise trade balance recorded a surplus in June of the order of $0.8 billion after a gap of over 18 years. India's foreign exchange reserves have increased by 56.8 billion in the current financial year, that is in 2021, so far during April to July, to $534.6 billion as on July 31st, 2020, equivalent to 13.4 months of imports. The ratio of foreign exchange reserves to external debt has gone up from 76% at the end of March 2019 to 85.5% at the end of March 2020. Let me now focus on the outlook for growth and inflation. Against this backdrop, the MPC was of the view that supply chain disruptions on account of COVID-19 persist, with implications for both food and non-food prices. A more favorable food inflation outlook may emerge as the bumper Rabi crop harvest eases prices of cereals, especially if open market sales and public distribution offtake are expanded on the back of significantly higher procurement. Nonetheless, upside risks to food prices do remain. The abatement of price pressures in key vegetables is delayed and remains contingent upon normalization of supplies. Protein-based food items could also emerge as a pressure point. High domestic taxes on petroleum products have resulted in elevated domestic pump prices and will impart broad-based cost push pressures going forward. Taking into consideration all these factors, the MPC expects headline inflation to remain elevated in Q2 2021, but likely to ease in the second half, aided by favorable base effects. As regards the outlook for growth, the MPC noted that recovery in rural economy is expected to be robust, buoyed by the progress in Kharif sowing. Manufacturing firms expect domestic demand to recover gradually from Q2 and to sustain through Q1 21-22. On the other hand, consumer confidence turned more pessimistic in July relative to the preceding round of Reserve Bank's survey. External demand is expected to remain anemic under the weight of global recession and contraction in global trade. Taking into consideration the above factors, real GDP growth in the first half of the year is estimated to remain in the contraction zone. For the year 2021 as a whole, real GDP growth is also estimated to be negative. An early contraction, or rather an early containment of COVID-19 pandemic may impart an upside to the outlook. A more protracted spread of the pandemic, deviations from the forecast of a normal monsoon and global financial market volatility are the key downside risks. The MPC noted that in an environment of unprecedented stress, supporting recovery of the economy assumes primacy in the conduct of monetary policy. While the space for further monetary policy action is available, it is important to use it judiciously to maximize the beneficial effects on the underlying economy. At the same time, the MPC is conscious of its medium-term inflation target. The headline inflation prints of April and May 2020 are obscured by the spike in food prices and cost push pressures. Meanwhile, the cumulative reduction of 250 basis points is working its way through the economy, lowering interest rates in money, bond and credit markets and narrowing down the spreads.